Hi, all, Ben here from East West. I'm just going to take a bit of an overview of the SPX. It's a bit of a proxy for everything. I'm going to put forward the argument for both sides, for both the bulls and the bears, and then you just take whatever you want out of that. So I thought I'd start this week. I'm going to actually just take a look at US recessions. So just looking here, these green boxes represent the COVID recession, what they call the Great Recession, the early 2000s recession. This was the early 90s recession. These are from the 80s. I'm not going to bother too much with those, but I'm just going to bring in a few other things here. So just to make this a little bit. So this line here is the US 210 curve. So that's the difference between the 2-year rates and the 10-year rates. And the way we work that out is we take the 10-year rate and we minus the 2-year rate. And obviously at the moment, the reason this is printing so negative is because the 2-year rate is higher than the 10-year rate. Historically, you'd find that longer term rates will tend to be higher because obviously people want to be paid better for having their money locked up for so long. Down the bottom, this is just basically the US overnight cash rate. So what can we garner from this? It's sort of, we're going over sort of some things that we already know, but let's just move in closer to these and have a bit of a look. So just when we look at this early 90s recession, obviously we had I'll just call it the curve because that's what it is. The curve went negative, even though it sort of bounced around the negative positive line here. But eventually, you can see here the cash rate. Now, one thing I think you can see here that the cash rate, even though it's been cut, the stocks aren't really responding. But I think the important thing to note here is that even at this point, when the stocks did have quite a fall, and that's not a nothing fall, even though it looks it on the chart, but that's a 20% fall. It's a pretty decent fall. But you can see here that the stocks fell even as the cash rate was coming down. So even though there were rate cuts, stocks were still coming up. And you can see here that as the 2-year rate got cut, the curve started steepening. But the point here is that stocks came down even as the rates were being cut. Next one here, same thing again. This is the tech wreck. So this was actually the period that we were in recession, but obviously the curve's gone negative again. And here too, I think this is the point. Even as rates were getting cut, the stock market was still falling, and it wasn't until even when it got down here to the bottom, it was still falling, and rates are really low down here. The GFC, we came back down here into the negative area, and then once again, even though rates are being cut pretty hard through here, we had a flat period here, but even as they're cutting down to QE, the market was still falling, even in the face of rate cuts. So even here, obviously COVID was a bit of a different situation, but the curve did basically go negative at this point. And look, this was so swift. I think this was so swift because as soon as the Fed announced that they were going to do QE again, everyone pretty quickly cottoned on to what that meant. And obviously we went on this insane rally. And that leads us to the present day where the curve has never been more negative as far as I can tell. Rates are rising. But, if sort of things go flat and then this goes off, what history suggests is that does not necessarily mean that we just do this. What it has shown in history is that it's probably likely to do this before it does that. That's what we've seen in history. But also worth noting that we don't have a recession as yet. Now that leads me to thinking about the long-term chart and looking at the long-term cycles that Malcolm at Norvast has provided. And you can see the only difference between 2020. I'm not sure I agree 100% with this, but 2022, 2023, the SPX will print a half cycle low on the credit cycle. Now that I can understand that we're looking for, as these credit cycles run about 22 years and they make half cycle lows and half cycle highs. Now the last credit cycle low was March 2009, and now we're into month 31, month 52, month 49. We're currently in month 31. So we are kind of expecting that in terms of these monthly sort of cycles that there's a half, as Malcolm said, half credit cycle high. It was in January 2022. 154 months. But he's basically pinpointing that sometime this year, and you're talking about a 22-year cycle, so we can't be exact to the day, but that we're going to make a cycle low before we go on to the next boom. But removing all the excesses of 2021 to 2020, 2021, I'm not so sure that the S&P is getting that low, but a lot of people will tell you that yes, it will. So Alex at Erlosky's kindly produced just to look at the weekly cycles in the S&P, and we're at about week 16 of this latest cycle. So in terms of where we're going from here, I am sort of expecting one more rollover, one more weekly rollover in terms of the cycles, but it remains to be seen. Of course, this is more a bearish look, but just looking at a lot of those factors, it just sort of feels like there's just another leg down. And just before I jump into some of the Elliott structures, I'm just seeing that there's just this cloud top here that I think the market's going to come up and tease. But I'm waiting to see. I'm going to need to see this break with some, velocity to start getting excited that perhaps the bear market is finished. The other thing I'm looking at is just this weekly RSI. Personally, what I'd like to see is movements to confirm bull markets above 60 and then holding 40. So we're sort of not there yet. It's just something I'm looking at. But the market, certainly for me, just on this basis, hasn't really done enough just yet. I think it's still going to start to struggle with this cloud. But I'm kind of thinking just from the structures that it might just pierce the top before coming back down. But we'll see. So just looking at this daily, this is on a bearish scenario, and I did tweet through the week just to note that this line here represents 20% off the lows, which if we got above there would effectively mark a bull market. So we teased it, but we didn't get there. Now, I have been struggling a little bit to try to work out exactly what's going on with this, with the idea that we're going to come down and make one more low before we move on to the true bull market. So I had been looking at it like this, but I just was looking at revisiting some of Sam at Trade Devil's work, and he's got this count which I quite like. Now he's come up with this move down being a leading diagonal, but the one thing I kind of like with this one is that it's not contracting. So even though I think you can make the case that this has moved in 5-3-5-3-5. 5-3-5-3-5. This is definitely a 5 to finish. So even though it's not moving in the 3-3-3 that you might expect in a diagonal, it's not a contracting diagonal, which is something you'd expect at the end of a movement, not the start. And a lot of people have been counting this up as a diag and it's contracting. I'm not sure I like it. Nonetheless, I digress. So the good thing about this, it's something I'd sort of touched on, but when we sort of look at this whole movement, we know that we came down here and just touched into this 50% zone. Okay, so that would set up the large pitchfork, where the bulls would be expecting to make the median line, but I think if we make the median line off this pitchfork, that means that this count's blown. But I think that the interesting juncture that we're coming to here is when we start to, even just taking this Elliott wave off, we'll just take it off. We know that we're coming once again into the retracement zones. Now, this is a little bit even more pronounced on the futures, but what I'm saying is that the same way that the market would like to hold this zone, the market's almost certainly going to run into some resistance through this zone. Okay. Now, one thing that's kind of interesting here is if we start to take things like this pitchfork, which is kind of interesting, is that the market will be looking for the median line of that, and it's kind of lining up to where you'd sort of think that these tops will be attacked, because this was the last area. You can see here we sort of held, failed, tested, and now we're testing again. But it comes into this zone, which I think is kind of nice. Now, the next thing that Sam pointing out, this isn't me, even though I'm aware of this sort of situation, I've pointed it out before, is if we take this into a measured move scenario, this is held quite nicely in its own zone, which is, where you'd expect. So this has come up and held and come up again, and then this sort of target is sort of just laying within this zone. And I think that's what Sam is pointing out, is that anywhere up here is going to kind of attract the attention of the sellers, both human and algorithmic, it would be suggested. Now, I think the 78.6 also lays in there. Yeah, the 78.6% of this move sort of lays in here as well. So you've got all this stuff going on within that zone. And then it just kind of looks like you can make the case for A down here. It just kind of looks like you can make 1, 2, 3, 4, 5 up here for an A, B, C down for a B wave, and then we're in the process of just putting in another impulse that's going to finish us off the top. So I'm kind of at the moment thinking that we're doing a little 4 wave in here. We're going to come up for a 5. We'll come for a sideways 4 before we go up for a 5 and finish, and then we'll come off. So I think what we'd kind of be thinking is that would be lining up somewhere around this top. So this may not, it's not exactly to scale. I don't know where it's going to go, of course, but I think that this top up here, so just around these sort of low 4300s, this is because we know that we're just creeping into that retracement zone, that just through here is just going to be, maybe it's something a bit more like, maybe this 5 wave's a little bit shorter and this 4 wave comes down a bit and this 5 only comes up to here, but this sort of thing, that's what's going to finish us off, and that's how we're going to structure this whole bearish movement. So even though we can sort of put this sort of trend channel on here at the moment, I'm not sure that the market's going to be able to come up and grab this in time before it comes off. So from a bearish perspective, that's kind of how I'm tracking it. I think this is pretty much starting to win out as my primary scenario. I think I've still been looking for signs that the market's going to top out and that this is just another bear market rally, and this is going to do it in another 3 wave, that we're going to come up here for a 3 wave before we come back down. That's where I sit. I mean, you would have thought the same thing here. Like by the time we would have got to here, you would have thought, oh, it's all over. We're going up, and then look what happened. So we're doing the same thing here. Time will tell. So that's kind of it for the bearish outlook for the moment. So I just wanted to have a look at the bullish case. Now, the one thing I did want to sort of point out, and I can't believe that the bulls, of which there are plenty, aren't jumping up and down about this a bit more, but this is a golden cross. Okay, the 50-day moving average has moved above the 200-day moving average. Now, we know that when you go back through history, that these golden crosses have proven to be extremely good times to buy the market. It's the oldest sort of TA in the book. Obviously, we had a bit of a fake signal here, but you get the point. When the 50 goes above the 200, it's very rare that it steered you wrong. In fact, I did a quick Python test just on the SPY, the spider, back to 2000. And when you look at the stats, just doing a golden cross, starting with $10,000, well, what did you do? You ended up with $34,000. So the point is that the return on the golden cross was 248%, and at the same time, the buy and hold return was only 183%. So, the point is that the golden crosses have very rarely steered you wrong in the market. When we've had them, they've always proved profitable, and we've got another one. So why would you not pay attention to that? I think it's just something that the bulls just aren't really jumping up and down a bit more about. But yet there it is. It's a golden cross. I mean, we might need a few more days or a week or two to confirm it with the 50 still going up, but I think the 50 is going to keep going up. This stuff's going to drag it up. So I think this golden cross is going to become more stark over the next week or two. But is it a harbinger of the rally to come? And so really here, nothing else has changed. We still have You know, we still got this divergent bottom in the RSI. We've moved further through this trend channel now. It's almost getting too far to call it a deviation. And the RSI held 40 on the downside. So, you know, all the boxes are ticked there for the bulls, as they were last week. And so this has been the count that the bulls are leaning on, that we've got some sort of, maybe it's a WXYXZ, something like that. But you've got to have to call what is clearly a 5-wave, a 3-wave. It's clearly what I think is 5 waves into 3 waves. So I think it's difficult to call this a double zigzag. Some people will. But spilt milk under the bridge. The point now is that they're saying, well, we've gone up for 1, we've come down here for 2, we're in the process of putting in the big 3, which would call for some sort of count, 1, 2, 3, 4, 5, like this, maybe see down here for 2, and then a 1, 2, 3, 4, 5 for a 1 wave, come down for a 2 wave, in the process of putting in yet another impulse. That means that both in the bull and the bear structure, we're going to get some sort of wave forward, because they're both saying that we're in an impulse here. It's just that the bear structure would suggest that the impulse is going to finish up here, whereas the bullish structure says no, it's going to do this and then it's going to go again. Okay, which one's right, which one's wrong? I don't know. Like, take what you will from it. I'm still leaning at that bearish scenario. I just think that there's just more to play out here, and that there's just not enough pain going on. I mean, time will tell. I'm just spitballing about what I'm seeing structurally, okay? And I've got 2 scenarios there. Which one's going to be right? I'm leaning at the bear, but it's very easy for the bulls to make the case, I think. So, look, I'll just leave it there, because I think there's just more water to go under the bridge. But like I said, my main case is, in line with Sam from Trade Devils, is that we're going to get this and then we'll go. I don't think we're going as low as like what Malcolm suggested, but it's always possible, of course. But I just think there is one big more leg down, but we'll see. If we're going to get one more big leg down, the only thing I reckon I can guarantee is that every bear is going to have their conviction absolutely shaken, and every bull is going to call victory way before it eventuates. So I'll leave it there for now. Take what you will out of that, and we'll see you next time. Thanks for watching.